Gold. The name alone evokes images of ancient treasures, powerful empires, and untold riches. For centuries, this precious metal has captivated humanity. It's a universal symbol of wealth and prosperity, transcending borders and cultures. From the pharaohs of Egypt to the emperors of Rome, gold has always held a special place in our collective consciousness. But gold is more than just a shiny metal. It's a financial time traveler, a store of value that has endured for millennia. While paper currencies rise and fall, gold remains a constant. It's the ultimate safe haven asset, a refuge from economic storms and geopolitical turmoil. Why? Because gold is scarce, durable, and universally desired. It can't be printed out of thin air like fiat currencies. It holds its value over time, unlike perishable goods. And it's recognized and valued all over the world. This inherent value makes gold a unique and compelling asset class, one that has stood the test of time. Like any commodity, the price of gold dances to the rhythm of supply and demand. When supply is tight and demand is high, prices soar. Conversely, when supply outstrips demand, prices fall. But with gold, it's a bit more nuanced. Gold's above-ground supply is finite. New discoveries are rare, and mining is a costly and time-consuming process. This limited supply provides a natural floor to gold's price. On the demand side, we have a multitude of players: investors, central banks, jewelers, and industrial users. Investment demand, driven by fear or uncertainty in the global economy, can send gold prices skyrocketing. Conversely, periods of economic optimism and risk appetite can dampen demand, leading to price dips. It's a constant tug of war, a delicate balance between those seeking a safe haven and those willing to embrace risk. Central banks are major players in the gold market. They hold vast reserves of gold, a legacy of its historical role as backing for national currencies. These institutions can influence gold prices through their buying and selling activities. When central banks like China or Russia increase their gold reserves, it signals a lack of confidence in the US dollar and other fiat currencies. This buying spree can put upward pressure on gold prices. Conversely, large-scale selling of gold reserves by central banks can send shockwaves through the market, depressing prices. The actions of central banks are closely watched by gold investors. They provide valuable clues about the global economic outlook and the perceived stability of the current financial system. Are central banks accumulating gold as a hedge against future uncertainty? Or are they reducing their exposure, signaling confidence in the global economy? The answers to these questions can move markets. Section 4. When the world trembles, gold shines. Geopolitical events have a profound impact on gold prices. When the world is gripped by uncertainty, gold becomes a beacon of stability. Gold thrives on uncertainty and fear. It's during these turbulent times that gold truly shines, offering a sense of security. It's the go-to asset when the world is on edge, a safe haven in times of crisis. Investors turn to gold to protect their wealth. Wars, terrorist attacks, political instability, and pandemics. These events can trigger a flight to safety, sending investors flocking to gold. The more chaotic the world, the more attractive gold becomes. Think back to the 2008 sovereign debt crisis or the COVID-19 pandemic. Both saw similar reactions. In each instance, gold prices surged as investors sought refuge from the storm. When trust in the system. Section 5. Inflation and interest rates, the push and pull of gold's price. Inflation and interest rates are two key economic indicators that influence gold prices. They are like the two sides of a coin, each playing a significant role in the financial markets. Inflation, the rate at which prices for goods and services rise, erodes the purchasing power of fiat currencies. This means that over time, your money buys less and less. Gold, on the other hand, is a tangible asset with intrinsic value. It is not just a shiny metal, but a store of value that has been trusted for centuries. It has historically held its purchasing power over time, making it a good hedge against inflation. People have always turned to gold in times of economic uncertainty. When inflation rears its ugly head, investors often turn to gold as a way to protect their wealth. It acts as a safe haven, providing a sense of security. Interest rates, the cost of borrowing money, also play a role in gold pricing. They are a critical factor that investors watch closely. Gold, unlike bonds or savings accounts, does not pay interest. This makes it unique among investment options. When interest rates rise, holding gold becomes less attractive, as investors can earn a higher return elsewhere. This shift in investment strategy can impact gold prices. This can put downward pressure on gold prices. Investors may sell off their gold holdings in favor of higher-yielding assets. Conversely, when interest rates are low or negative, as they have been in recent years, gold becomes more appealing. It stands out as a reliable store of value. It's a store of value that doesn't erode your purchasing power, even if it doesn't generate a yield. In uncertain times, gold remains a steadfast choice for many investors. Section 6. Gold's Future. A glimpse into the crystal ball. Predicting the future price of gold is a fool's errand. The market is influenced by a myriad of factors, making it nearly impossible to forecast with precision. Too many variables are at play, from global economic growth to geopolitical shocks. Each of these elements can have a significant impact on gold prices, often in unpredictable ways. However, we can look at long-term trends and current market conditions for clues. By analyzing historical data and understanding the broader economic landscape, we can make educated guesses about where gold prices might be headed. One thing is certain, the factors that have driven gold prices in the past, central bank actions, geopolitical uncertainty, inflation, are still relevant today. These elements continue to play a crucial role in the market. As long as these factors persist, gold remains an important asset class. Investors often seek gold due to uncertainty, viewing it as a safe haven to protect their wealth. Looking ahead, several factors can support higher gold prices. Aggressively to combat inflation, it could make gold less attractive to investors. Higher interest rates can increase the opportunity cost of holding non-yielding assets like gold. If central banks raise interest rates aggressively to combat inflation, it can make gold less attractive